Everyone planning for retirement faces a terrifying math problem. You need market growth during your working years to combat inflation, but once you stop working, you face the very real risk of outliving your savings. To solve this tension, the Indian government created the National Pension System, or NPS. Originally launched in 2004 for government employees, it has since evolved into an all-citizen model that allows any individual to build a retirement corpus. The immediate financial incentive is the tax structure. You get the standard deductions under Section 80C, but the NPS also grants you an additional 50,000 rupee deduction under Section 80 CCD 1B. By shielding your income from taxes on the front end, the NPS leaves you with more initial capital to compound in the market over the next several decades. The system uses an unbundled architecture centered around a single PRAN, a permanent retirement account number. This number identifies your holdings across two distinct sub-accounts. The first is your Tier 1 account. This is the default pension vault. It holds the tax benefits we just mentioned, but it comes with strict rules on when you can actually touch the money. The second is Tier 2. This is a voluntary investment account. You can withdraw from it whenever you want, without restrictions. The trade-off is that Tier 2 offers no tax benefits. By separating the system into these two tiers, the NPS addresses a basic behavioral flaw. It provides a liquid account for short-term needs while intentionally isolating your core retirement funds from daily spending. These four containers represent the asset classes to generate wealth: equity, corporate bonds, government securities, and alternate assets. Under Active Choice, you manually set equity exposure up to 75%. Alternatively, Auto Choice automatically shifts exposure from equity to safer bonds as you age. You get market-linked growth tools designed to outpace inflation during your highest-earning decades. But that market freedom comes with systemic constraints. The Tier 1 account is not meant for general spending. Prior to age 60, partial withdrawals are limited. You are capped at 3 withdrawals over your lifetime, and you can only take out up to 25% of your own contributions. The market returns are off-limits. Accessing these funds requires a specific qualifying event. You are restricted to milestones like buying a first home, children's higher education, or facing one of 15 specified critical illnesses. By making the money difficult to access, the system protects your compound interest. The friction ensures the money stays invested for its intended purpose. The accumulation phase ends on your 60th birthday. This is where the rules of payout begin. This chart maps out the normal exit protocol. At age 60, you can withdraw a maximum of 60% of your total wealth as a tax-free lump sum. The remaining 40% is subject to a mandatory constraint. You must use that money to purchase an annuity from an approved provider. If you exit before age 60, you trigger the premature penalty. The ratios flip. You are forced to lock 80% of your funds into an annuity, leaving you with only a 20% lump sum. The system discourages early exits to ensure the wealth you built is preserved for retirement rather than being spent decades earlier. An annuity is a financial contract. In exchange for a lump sum, an insurance company guarantees you a steady monthly pension payout for the rest of your life. You don't have to exit exactly at 60. The regulations allow you to defer your lump sum withdrawal or annuity purchase all the way up to age 75. You can customize these plans to cover a surviving spouse or ensure your original purchase price is returned to your heirs after you pass away. The NPS provides the market-linked growth needed to build a corpus, but by combining that growth with strict withdrawal limits and mandatory pensions, it enforces the discipline required to ensure you never outlive it.